Good morning, ladies and gentlemen, and welcome to the KITWAVE Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Paul Young. Good morning, sir.
Yes, good morning, and good morning, everyone. I think we'll start just by introducing ourselves. My name is Paul Young. I started the business 35 years ago and presently act as CEO.
Good morning, David Bryn, Group CFO. I joined the business just on 12 years ago when Paul took on the first round of private equity investment with a background in M&A and corporate banking. I've been responsible for driving forward the internal control and rigor metrics around the financials, but also developing the IT infrastructure, which we have across our whole group, and the now 12 acquisitions that we've undertaken during that time.
Good morning, Ben Maxted, COO. I joined KITWAVE just over 10 years ago as the finance director of one of the ambient businesses just after acquisition. Then went on to run the frozen and chilled division and subsequently stepped up onto the PLC board November 2021.
So I'll give you a brief introduction to the business. Well, a plotted history, 35 years of history in 2 minutes, but here we go. So what is KITWAVE? KITWAVE is a delivered wholesale business. We commenced trading, let's say, 35 years ago with the purchase of a business called M&M. At that stage, that was a business which traded £2 million per annum. We now do £2 million per day. So the business has grown during that 35-year period of time. We deliver a full range of products to the independent trade, of which there are 450,000 customers. We deliver to 42,000 of those customers. And what do I mean by independent trade? I stress this point because that is our specialism, delivery to independent. Independent trade for us, it's convenience stores, it's restaurants, it's pubs, it's cafes, it's schools, care homes, leisure centres. That's what our business is, and that's what we'll focus on as we go through our slide pack. Our USP, because I think you need a USP to be able to be successful in this sector of the market, it's range, it's availability, it's service. We pride ourselves on our delivery. We're on time, in full, every time. And that's our point of difference. We're not about price, we're not about being the cheapest in the marketplace, we're about our service. We specialise in the sale of impulse consumer products. That's the sort of thing you're going to touch and hopefully try every day. It's chocolate bars, it's snacks, it's soft drinks, ice cream, and plus we also do a full range of frozen food, chilled food, fresh food, and alcohol. So basically everything you can see in the store, KITWAVE can physically provide. Just a quick mention, I think, of the marketplace. We'll come back to this as we go through the slide pack, but it is a large market. It's a £30 billion market, and it's supplied by hundreds of wholesalers. The fragmented nature of the marketplace is what gives us our M&A opportunity. So we anticipate, and we'll talk about the strategy again as we go through the pack, growing via M&A and growing via organic growth. So basically, we floated in February 21. We used the float to pay down the debt that was built up with private equity. We'll finance our acquisitions out of our own cash flow. And we have a sort of discipline within our business saying we will not go beyond 2 times leverage as we grow via future M&A. Just on this particular slide, I think it's worth just referencing KITWAVE now is a business of some scale. We have a foundation from which we can grow. We've got 547 delivery vehicles. We've got 30 warehouses, 700,000 square feet of space. We've got 1,400 employees. And most importantly, we've got 42,000 independent customers. And we'll tell you why that's important as we go through our pack. Brief introduction to the board. We've obviously introduced ourselves. Worth mentioning our chairman, Steve Smith. Steve has extensive knowledge of listed businesses. He was CEO of Northgate. He also was non-exec at Ramsden's. So Steve's been our chairman for, you're going to remind me, David, 7 years?
Yeah.
7 years. Jed Murray joined us when we actually floated. Jed acts as non-exec. And Teresa Octavio joined us just in February of this year. Teresa is important to us because it adds diversity to the board from the point of view of we are a board of 5 accountants. Teresa comes from a background of Procter & Gamble, Kantar, so a different sort of balance to our board. So our slide pack, what we're going to do is we'll talk about our finances. Pleased to say we're on target, or we've met our market expectations. You probably are aware, but we raised our expectation by 40%, our forecast in July. We've met our expectations. We'll also talk about our sort of, I was going to say organic growth, not our, can't actually read the slide pack from here. Operation. Yeah, we'll talk about our operational sort of progress we've made this year and our commercial progress. This is actually really important to us because it's not about just creating profit in this particular year. It's about operational moves. Oh, that's better. Thank you, Dave. Operational moves forward, which will give us sustainability as we go into the 5 and 10 years ahead of us. Strategically, we'll talk about our acquisitions. We'll talk about MJ Baker, which we made in February 2022, and we'll talk about West Country, which we made just after the end of our financial year. We'll explain the reasons for that.
The October 21 year was, as many businesses, slightly COVID affected in parts of our business, and I'll talk through that as I go through the next few slides. But the strong start we had to H1 last year was continued and really pleasing to see coming through in the second half of the year to our more normal annualised trading levels, with an overall increase in revenues of 32% on FY21 and 27% ahead on a like-for-like basis, excluding the acquired business of MJ Baker. Control's a word you'll hear probably a lot. Control over finance structures, control over our disciplines about our distribution, and it's a key metrics for us internally, particularly around the control of our gross margin. And again, I'll talk through a little bit of that over the next couple of slides, but really pleasing to see the margin improve from 18% to nearly 20.5%. All well and good as being control of our top line, having control of those margins as a delivered solution business, no good if our bottom line distribution costs go out of kilter as we grow the business back and continue to grow in the future. Really pleasing to see the efficiencies that we've got in that part of the business have been maintained, and there's a lot of work that Ben will talk you through over the slide pack as to initiatives we're undertaking to ensure that efficiency of service and quality of service is maintained, but as in a cost-efficient way as possible. And as a result, our operating profit for the year improved from 7 million to 21.5 million in the last 12 months. So if I look, I guess, in a bit more detail across, well, what does that mean for each of our parts of our business? We look at our business in 2 ways, which is the retail and wholesale market, retail and convenience, and also the food service market. Our ambient and frozen and chilled divisions really report to that retail and convenience customer base. The ambient business has increased by 19%. And importantly, the margin structures in that ambient business have also developed, and we've taken gross margins from 12 to just over 14% as a result of where price rises come through. One of the key metrics we have in our business, price rises from the brand owners. A majority of our goods are branded, so your Nestlé's, your Mondelez, etc. They will pass prices rises through to the market. But our key metric is to keep hold and increase our little bit of margins where we can there, which generates the additional cash gross profit to cover our own overhead inflationary base. Frozen and chilled saw, again, a good increase in the year with a 18% increase in organic growth, 30 million of revenues. And it should be important to note here that both in ambient and frozen and chilled, that was good case rate growth, as well as price inflation growth. So it was actual pure growth in the business as well as the price inflation on the market. Food service saw the biggest return of trade as we returned out of the COVID period with 72% effectively organic growth. You're not going to see that every year with our business, so I'll put that marker in the sand. But it does show the strength of the relationships we've got with our customers, that came back very strongly and very quickly. Again, there was about a 35% case rate growth in that business, and about 35% increase due to price rises, particularly in the commodity areas, dairy, chilled, sugars, etc., where there was some high commodity price rises during the year. Again, really pleased to see the improvement in the margins from 24 to 27%, and that was good control, but then also slightly a margin mix change where the food side of food service, you would expect to command margins around 30%, as opposed to the alcohol on trade, which is 23, 24%. So very pleasing performance across each of the three divisions with, I think the important note there is the fact that it wasn't one division overperforming to compensate for underperformance in other divisions. It was good strength across the whole group. And as a result, we've spoken about it already, 32% increase in revenues with a good mix in case rate, price rise inflation and M&A growth. And that talks to our ongoing strategy of growing organically, growing via the M&A opportunity that Paul's articulated that the market provides for us, but then using that M&A to drive further organic growth in the future. I think as well, slightly unusual on the right-hand side of the chart here, but you would normally expect to see organic growth in our sort of market of 3 to 4%. You're not going to see the market indications, but what you would and should expect to see is KITWAVE outdoing the market year on year, and that's what we've done historically, that if the market has grown 2 or 3 times, 2 or 3%, we would always outgrow that by 4 or 5%. So just finishing off on the operating profit, distribution costs I've mentioned are key metric for ourselves, and that cost to service, we call them, our warehouse wages, our delivery costs. Paul said we've got a fleet of circa 550 delivery vehicles. So the adjusted operating profits are 4.3%. Food service operating margins 7% and rising, and you would expect that to be a bigger portion, blended portion of our business going forward. So that inherently you would expect to see further developments in operating margins over the future years. Our balance sheet remains strong with 72 million of net assets, 30 million of acquired goodwill as a result of the MJ Baker position. And despite the great growth in the business, you'll notice here one of the key metrics we have in our business around our working capital control. And working capital actually only increased by £100,000, despite the fact that revenues grew dramatically from 380 to over £500 million. And that's down to good control with further stock turn, improving credit limits with the brand owner supplier partners, and very tight control over the credit limits we provide to our end customers, and seeing that control in the debtor book there. So pleasing to see the working capital continues to be under control, and we would target over 95% LTM 12-month averages at all point in times on our working capital cash conversion. Our investment in the business, capital investment, continued with the new Wakefield depot, which added 4.5 million of right of use asset and lease liability. Fleet investment during the year in cash terms around £2 million, slightly lower than normal, just longer lead times on metal builds from brand owners such as DAF, etc., where we get our delivery fleet from, and there will be a bit of catch up in the next couple of years. We would normally expect that to be between £2.5 and £3 million. So we finished the year with net debt of 43.6 million, which include 26 million of RFS lease liabilities. The majority of those are our properties. 20 million of that is our properties, our depot network that we operate from. So excluding IFRS 16, average of 0.6 leverage and 1.5 times leverage, including those liabilities, well within our stated aims of not really going over 2 to 2.5 times and then de-gearing very quickly. How can we de-gear very quickly? Because the cash generation in the group historically and continues to be extremely strong. So I guess going back to that M&A philosophy of how will we fund M&A, the MJ Baker acquisition last year, 17 million, was effectively fully funded from the cash generated in our business of 17.5 million, even after paying 4.9 million of dividends as a full first year dividend post listing on the market. So strong cash controls, strong cash generation, continued investment in our business, continued investment in M&A on a lowly geared platform, and that's the control you would expect to see from KITWAVE year in, year out going forward.
Thanks, David. I just talked through kind of the operational and commercial progress that we've made in the last 12 months and into FY23. As David said, we kind of look at the ambient division and the frozen and chilled division as one division that really operates within retail and convenience. Within the ambient division, as David said, we've driven case numbers 14%, whilst also driving margin percentage up 2%, gross margin. I guess how do we do that? And it comes back to I guess our USP, and that is the breadth of our product offering and that consistency of range availability really differentiates our service levels to customers in the marketplace, and also makes us an stalwart really of the brands within that independent convenience sector, that hard to reach small independent sector that needs frequency of delivery, small drops. And our kind of fleet and infrastructure enables us to really deliver that into the marketplace. We continue to look at our cost to serve. It's kind of in the DNA of the business that obviously, as David alluded to from a financial perspective, that cost to serve is a high proportion of our overhead, and therefore we continue to drive efficiencies within that cost to serve base. And one example of that, which we've just initiated, is the use of virtual reality. So we've initiated a virtual reality program to create a digital twin of our distribution centres. This will allow us to model the current operational process flows and evaluate approved warehouse layouts before implementation. What does that give us? That gives us a virtual reality environment to model and analyse FLT and operative movements, time and motion studies, bottlenecks in process flows, and really looking at the most efficient product flow from goods in through to replay and into pick and then through dispatch. It also enables us to model and think about technological advancements. We've always looked to invest in technological advancements which drive efficiencies like voice technology, RF scanning of goods, and latterly I think we'll also in time look at things like robotics. So I think what that will give us moving into FY23 is some efficiency work streams that we can roll out into our warehouse network, starting with ambient and then also the larger distribution centres across our network. Within that 30 depot network, we'll also have this VR modelling done with it. Moving into frozen and chilled, as you can see from the heat map there, we go to a lot of postcodes. So we're in every postcode 3 times a week. We have a lot of infrastructure that enables us to do that, and really to drive operating margin and therefore leveraging that turnover within frozen and chilled. It's really about focusing on that cost to serve within that division. So we've done a lot in the year. We have a contribution per drop focus. What does that mean? Well, essentially, we've increased our minimum order quantities. We've looked at drop densities, and really we've done a full review of our delivery matrix to ensure that we are delivering as efficiently as we possibly can within all those 19,000 touch points that are in that frozen and chilled division. Operationally, we've looked at, again, our warehouse efficiencies. We've taken the decision to close one depot, which was a small Reading depot. We invested about 2.5-3 years ago in a 70,000 square foot distribution centre in Luton. And now that is completely on stream, it makes sense for us really to take that Reading depot and cannibalise that into the Luton depot. The Reading depot didn't offer both chilled and frozen, and therefore moving it to Luton will also enable us to cross-sell both product sets into that customer base in the south. We've also moved the Kirkham depot, which is in the northwest, from a stock hold depot into a last mile delivery depot, again with stock being picked in the northeast and then transshipped overnight for onward delivery from the Kirkham depot locally. Within food service, we've made obviously the 2 acquisitions within food service, as we stated at IPO, that the likelihood of M&A will be in the food service sector, and we're pleased that we've got the 2 acquisitions, MJ Baker and West Country, both in the southwest. Now, what does that give us? It gives us 5,000 customer points in the southwest, and I think more importantly, it gives us the organic growth opportunity with fresh. I think fresh was really the last piece of the jigsaw for us in terms of delivery capability within food service. We didn't have category expertise in fresh foods, and obviously we have that in abundance now with West Country. So what's the organic growth strategy? Well, very simply, it's to sell more to our existing customer base, and I think the southwest, we will be able to prove that cross-sell strategy with MJ Baker's selling little to no fresh. They have 3,000 customers, and fresh runs at about 30% of the average basket spend within food service. So that will enable us an opportunity to cross-pollinate those 3,000 MJ Baker customers with fresh produce. And also West Country, they run at about 70% fresh, so over-indexing on fresh produce, and we feel that there's an opportunity there to cross-pollinate their 2,000 customers with ambient, dairy, chilled, frozen, and all the other categories that KITWAVE is a specialist in. So clear growth opportunities in the southwest. And to do that, we will need to invest in a new distribution centre in the southwest. We're currently looking at a site or some sites down in the southwest for a new distribution centre in Devon. That will enable us to scale and the growth capabilities to drive that organic growth opportunity in the southwest, with all categories being delivered to that 5,000 strong customer base. We've also in the year invested in our Wakefield on-trade hub, which gives us the scale and efficiencies we require within on-trade. And that has really driven that ability to centrally buy and inter-depot transfer stock, improving margins. Finally, just to point, the MJ Baker acquisition and West Country are integrated. We fully integrate our acquisitions. They go onto our IT platform. We obviously work closely with management and with our operational team of directors and managers to really work to harness the entrepreneurial spirit of those management teams, but also overlaying that control environment that we have. And a great example of that is the successful integration of our food-orientated food service businesses, David Miller and MJ Baker. They now operate as one buying team. They are essentially buying using those scale economies of the enlarged food service operation within KITWAVE, and West Country will obviously be linked into that as quickly as possible. We've invested heavily in our online order platform, our website, and we've developed that with all entities now on our new group trading platforms driven by Magento. What does that enable us to do? Well, it's driven electronic order capture from 22% to 35%, and average order values from 8% are higher by 8% online. And I guess, well, why is that? Our view is really twofold. I think the brand owner engagement has been really, really promising here. We've partnershipped with them. We've had access and worked in partnership with their e-commerce teams. And that's really enabled us to drive that e-commerce offering to our customer base. I think the industry average of electronic order capture is about 40%. And I think with our best-in-class websites, we feel that we'll be able to push well beyond 40%. I think just a point to note here, we have some 110 reps, sales representation and key account managers on the road, and also a telesales function. And I think the view is that we would like to make order capture as efficient as possible, digitalized, but we still see a huge benefit in that field sales force, because they are that conduit between the brand owners and that independent convenience sector for range advice, new product development, merchandising, and all of the value add that we can add into that independent sector is really important for the brands, and really continues that strong relationships that we have with them. Order capture, however, we would like to be as efficient as possible, and that really will be the pushing of that order platform.
So if we move to strategy, and I think as at the beginning of the presentation, our strategy is to grow via M&A, and then to benefit from the organic growth opportunity that creates. I think to understand where we're coming from, it's worth just looking at the market and understanding the size of the market. As I said, it's a £30 billion market, but you've got to look at that market and say, well, okay, who's actually in the marketplace? Who's playing in the marketplace? There are large players. There are Bouquet, there's Bestway, there's Nicer, there's Brakes, there's Bidfest. But these are companies who are turning over £2 billion, £3 billion, £4 billion plus. So we know they have a price advantage, and that price advantage may be 4 to 5%. That 4 to 5% for us is the difference between making a profit and not making a profit. So we take a view of that part of the market. Have we lost? No, okay. That part of the market, leave that to them. So where are they specialising? They're specialising in cash and carry. They're specialising in delivery to national chains or looking after large contracts. And I said at the beginning of the presentation, that's not our market. Our market is, let's focus on the independents. So we take that view and say, okay, put that to one side. Then also within the marketplace, there's about £7 billion of tobacco. and we're not a tobacco wholesaler. Tobacco traditionally very, very low margin. So you take that out of the marketplace. What does it leave? It leaves about £11.5 billion of market, which KITWAVE can actively attack over the next 5 or 10 years. Now that 11 billion, as I said previously, is supplied by hundreds of wholesalers. So there's the M&A opportunity for us moving forward. We're very clear with our M&A strategy. We're not about trying to buy cheap businesses and turn those broke businesses around. We're about buying a business that trades profitably and has traded profitably for many, many years. So we can take that business, we can put it into our sort of group structure, we can integrate it quite quickly. And then what we need to do is just enhance it and improve it by using the KITWAVE group philosophy, almost as an umbrella. Thinking about where we expect that sort of M&A to be in the future going forward, it will be in the food service sector of the market. Why particularly food service? It comes down to number of customers. Of the 450,000, 370,000 sit within food service. We service only 10,000 of that, so there's a real opportunity for future growth. We also look at the customer base and sort of say, well, why would KITWAVE be attracted to them? And it's about the fact that part of the market relies on service. It relies on that sort of put my order in at midnight and get a delivery the next morning at 9 o'clock. That's what we're good at. So it relies on service. It relies on range. No point in placing an order which only turns up 10 or 20% full. Again, that's a KITWAVE USP. And it comes back to that absolute level of service. It isn't driven by price. It's driven by, if I've got the product, I can take my product, which might cost me £1, and when I do it as a food service supplier, I'm going to sell it for £10 or £12. So large margins, but you only get a large margin if you've got the product. And that's what KITWAVE is good at, supplying the product. Hence, future M&A will definitely be in the food service sector. We've talked about the West Country acquisition and why we've done it. It does take us into fresh, but I think it's probably just worth me sort of saying that whilst we were interested in driving fresh, if we'd looked at West Country as a business and we found it had a very weak management team, then that purchase wouldn't be for us, because what are we buying when we buy an acquisition? As I say, we're buying a business that's traded properly and traded well. So that management team, critical to us. We look deeply at their employees when we go through our diligence work. Obviously, diligence is an awful lot of finance, but for us, we like to understand the business and get under the skin of the business. So we understand the management team, we understand the employees as importantly. And we could clearly see with West Country, they had a dedicated workforce. Many of that workforce had been there for 20 years plus. I'll give you a very good example of that. We're talking to the experienced buyer. We're actually talking to him. We talk about his history. He's 42, 43 years old, been with the business since he was 15. It's that sort of business. So that said to us, we're buying a very, very firm foothold in the Southwest from which we can develop our range and drive our business forward. And that's a typical KITWAVE acquisition.
I just touched on our organic growth strategy, and I think really by putting the building blocks in place, we feel we're in a strong position to continue to grow organically. And I'll just spend a few minutes talking through what we mean by that. So we have a large, diverse customer base, presenting an opportunity to sell more to our existing customers. We have 19,000 customers who only buy frozen and chilled foods from the group. So we see that as a huge opportunity, because frozen and chilled operates at about 25% of a customer spend within a shop. So clearly there is organic growth opportunities there. We don't feel that we would ever capture an entire store spend. That is really the nature of the independent sector. They're entrepreneurial in their purchasing. However, the temperature control goods are probably the hardest to deliver, and I think we over-index within that. So therefore there is an opportunity nationwide in time, as we build our infrastructure and our capabilities within ambient, to really offer a much broader range to that customer base that's currently serviced by that frozen and chilled division and currently buying from the group. We have strong and long-lasting brand owner support, and really we are that proven route to market partner in that hard to reach independent sector of both retail and convenience and food service. We have full product offering across all categories in retail and food service. And we have nationwide delivery capabilities across all temperature sets, with continued investment into infrastructure and capacity to grow. So we have capacity in our current warehousing and distribution model, but also with the right investment, we have the ability to really wrestle a higher portion of that wallet spend. And we have that well-invested IT infrastructure that really pulls it all together, with 35% of group sales captured through e-commerce. And really the aim to push to 40%, but also to continue to drive those operational efficiencies that we know that we can gain from the cost to serve. So really within both food service and retail and convenience, organic growth opportunities. And as we continue to do M&A, and M&A drives part of that growth story, there will be continued organic growth opportunities from those acquisitions as well. And then finally, I'll just touch on ESG. So within the year, we've done a lot of work streams, and we've really moved forward our ESG framework. We have engaged with BusinessWise and formulated an energy management strategy, which really involves load shredding in our temperature-controlled warehousing. We have a well-invested solar panel production with 360,000 kilowatt hours. Obviously, as you'd expect, all our new vehicles meet Euro 6 emission standards. And really, from a softer perspective, we reduced our packaging and food waste by partnering with a charity called Too Good To Go, who offer a portal to connect the public to ourselves for short-dated or package-damaged goods rather than going to landfill. And we have continued investment in our solar infrastructure with a PHEV scheme earmarked for our Luton distribution centre for FY23. From a social perspective, Tom Johnson joined us in the year. He's our new health and safety director, and he's brought a really new and infused culture to the business in terms of health and safety, and also a new online HSE portal is planned for FY23, which will digitalise health and safety in terms of incident management, compliance, regulatory compliance, and also all risk assessments will be online and far easier to use. We paid a cost of living pay increase of 8% to all employees that had not received a structural or national minimum wage increase in the year. And we partnered with Kickstart and Grocery Aid, and also with the Heart of the Time Foundation, raising £60,000 through charitable endeavours. As Paul mentioned, Teresa joined the board in February this year as a non-exec, obviously balancing the execs with the non-execs on the board. And we adopted the new enterprise risk management framework during the year. And really all of the other bits on governance is really what you'd expect, and something that we've had for a long time, going through 2 rounds of private equity, and we continue to harness those as we move forward.
So I think in summary, why is KITWAVE successful? It comes down to the fact, I think, that right from day one, we focused on, we will not be a price-led business. We'll focus on range, we'll focus on availability, we'll focus on service. And that's our USP, and it's been our ethos for over 35 years. But I think probably more importantly, our success comes from the fact that we've got 3 things. We've got the trust of our employees. We've got the trust of our brands, which is absolutely critical to us as we grow the business and move forward, that they stand beside us and we stand beside them. And I think probably most importantly, and overriding all of that, we've got the trust of our customers, and that's really critical, because if we're going to drive our business forward and grow organically, it's not just about just supplying frozen or just supplying ambient. It's about supplying the whole range, which means the customer needs to look at us and say, do you know what, can KITWAVE give me everything I need to make my business as an independent entrepreneur successful? If we can do that over the next 5 or 10 years, we've just got a business which will go from strength to strength. Fantastic to hit 500 million this year, but I think we're probably just on the first rung of the ladder. As I said, £11 billion market. The ability for us to grow from £500 million to £1 billion and beyond is well within our grasp.
So that's us. I'll just pass back to yourself now.
Paul, David, Ben, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Paul, David, Ben, we did receive a number of pre-submitted questions ahead of today's event. And as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this morning as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And guys, if I could just hand back to you to respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay, thanks everyone. Again, thanks for everyone dialing in. Apologies if there's a few reception issues during that, so hopefully the messaging came across. So I'll try and go through some of the questions and pass on to Paul and Ben if I sort of coordinate that. So question, how fragmented is the market, and can we talk a little bit about the competition you face? I guess, Paul,
I could touch on the fragmentation of the marketplace. I think first of all, competition, as I said previously, from the larger players, Break, Big Fast, Bookers, etc. If you look at the total supply base of the market, as I said, hundreds of wholesalers. Now, we are number 14th largest wholesaler in the UK at £500 million. I've mentioned the ones above it. Then you take the view of we're 14 and the market is £30 billion. So it follows that at £500 million, we're number 14. There are literally hundreds of wholesalers below that. So the competition for us are those wholesalers, but equally, that's our M&A opportunity. So we're relaxed about the competition because we have got a degree of scale in servicing that independent sector. I think if we were a business focused on servicing nationals or servicing large contracts, we would have an issue because we just don't have the scale. But we definitely have the scale when it comes from servicing independents.
Okay, thanks, Paul. So next question. What margin impact would we see as online ordering increases, and what other options are there from a tech point of view perspective to grow the margin going forward? Do you want to pick that up, Ben?
I think we don't really see a margin impact as such in terms of online gross margin impact. Obviously, our gross offering in terms of pricing is similar to what you'd see from a sales rep. So it's not as if we're having to reduce margin to sell online. So I think really it's about driving footfall to the website, and then really there are some efficiency savings that we'd expect from that. So from an operating margin perspective, you would expect some increases in operating margin, and really it's about growing top line turnover through average order value. In terms of other tech, I mean, there are lots of other bits of tech that we use or have earmarked in the business, really about from an operating margin perspective. So voice technology rollout, RF goods in and dispatch. I mean, we've talked about the VR modeling, Paragon routing, continuing to efficiently route our vehicles and how we can roll that and scale that within the business. So there are plenty of tech advancements. Robotics, probably a little bit too early for us. However, we have some work streams looking at those. So there are plenty of tech advancements that we could see really being used to drive down our cost to serve and thus increase our operating margins as we go through the next 3 or 5 year time horizon.
Yeah. Okay. Next question? What's the current headcount in the business, and how do we see this growing over the next 12 months? I guess I'll pick up part of that, and then guys can jump in if there's anything else. We have about 1,500 colleagues across the business, and the majority of those are in the warehouse or our drivers. We've said we've got a fleet of 550 vehicles and we employ our own drivers. It's an important last line of customer service for us, that driver is a key part of that whole work stream as a delivered solution business. I think we don't see that number growing dramatically. We've got good efficiencies, and actually as efficiencies come in, particularly in the warehouse on the picking, the more efficient we can look at that over the next 2 or 3 years, the more we can look at technological solutions and drive efficiency in that part of the warehousing. It should create operational efficiencies for there in terms of the personnel required. So overall, about 1,500. We do not see a dramatic increase in the number of people required going forward. If anything, we should be driving efficiency the other way. This will be a quick one, I think, Paul, but just linking with M&A, do we have any plans for expansion outside the UK, either directly or indirectly through M&A?
No, I think it's always been a clear philosophy of KITWAVE. Do what you know, and we know about the UK market. We know about the wholesale market in the UK. We don't really understand what's out there from a foreign perspective. So that's something that we would avoid doing. Equally, as mentioned, probably mentioned 3 or 4 times now, we've got an £11 billion market to go into. So lots of opportunity there. There is no ceiling in the near or even far future.
And I guess linked to that, Ben, you might want to pick up using the West Country as an example. But we mentioned small bolt-on M&A is easier to source many smaller operations to aggregate than, say, doing a larger deal to step change the operation. I think if I quickly just jump in there, firstly, in terms of that market and the fragmentation, I think it's important to know that there isn't a myriad of larger businesses there to do a step change, but B, the benefits of bringing some of the small operations together far outweigh thinking about a step change, and there's a number of them. So that is the philosophy going forward, but you might want to talk a bit more detail about the different pots that you can target.
I think also just on that, I think the ethos of the business is we are a risk-averse business, and I think that sounds quite, at odds to an M&A driven growth strategy. But I think where we sit within the marketplace is we're very aware of the market. We're very aware of where we feel that we can grow, and I think those targeted kind of M&A acquisitions at say 20 to 40 million of turnover, 1.5 to 2.5 million of EBITDA, that's never going to rock the business. It's never going to kind of put the balance sheet at risk, and I think that's absolutely fundamental to the way we operate the business. I think where we take on smaller acquisitions, we feel that we can really take synergistical advantages from that as well. So we have plenty of opportunities to grow our margin through buying power. Paul mentioned that we often have and do have scale advantages over those smaller acquisitions. We have sometimes a sale out benefit as well if we're operating in the same geographical location. So, often cutting up each other's throats at the customer level, so we can increase our margins that way. And then from an integration perspective, how do we use KITWAVE's infrastructure and delivery capabilities to drive down that cost to serve within that acquisition, and therefore drive operating leverage through utilising our infrastructure or polishing and investing in the infrastructure that we've purchased. So plenty of opportunities for synergistical benefits that come from these acquisitions, again, driving operational profit.
Thanks, Ben. Pre-submitted question here. With inflation a factor in supply chains, what measures do KITWAVE implement to ensure that it does not affect the business model? In normal courses, inflation is not a bad thing for a distribution wholesaler. We don't mind a bit. Why is that? Because if you look at our cost infrastructure, about 70% of our admin and distribution costs are inflation related. Their wages, their motor fuel and motor expenses. And in total, that's about £60 million of spend a year. Now, let's keep the math simple. I'm a simple accountant, but if they went up 10% year on year because of inflation, wage inflation, fuel inflation, what we've seen, effectively it's £6 million of additional cost that you have to cover off as part of your business. And it goes back to that control point that I was talking about before in our business. If there's inflation in our base, there will be a bit of inflation in the top line base as well. And with 500 million of revenues, if that went up by a similar 10%, same number of boxes, 550 million of revenues, the extra 50 million of revenues at our 20% margin more than covers in cash terms that additional inflationary pressure in our own cost base. The key metric there is to always be aware of the margins, the cost to serve below that, and if there's opportunity or there isn't opportunity because of brand rise and increases, you just have to look at your market and say, actually, we need some of those price rises anyway. But it's about that gross margin control, and with the scale benefits that we have, we will always be able to more than cover inflationary pressures in our own cost base, and that's effectively what the numbers for the October 22 year have shown in the last 12 months, where we've kept control of that.
Take up on Robert.
Question here, do we have any operations in Northern Ireland?
No, we don't have any operations in Northern Ireland. we utilise some customer bases in Northern Ireland in terms of sales opportunity, but we don't have any operations in Northern Ireland, and nor do we see that as probably a strategic acquisition or growth strategy for the short and medium term.
Okay. Just seeing if there's any other questions here that I don't think we've already answered during the presentation. We've spoken about that. Should we cover that one, Ben?
Yeah, we can do, yeah.
Are we planning to open further depots? So where and why?
I think obviously I've touched on the southwest. Obviously, we feel that there's an opportunity in the southwest for growth opportunities, and I think if we look at our 30 depots across the UK, I think over the next 5 years there are opportunities to look at investment within some larger scale distribution centres and cannibalising some of those depots to make it more efficient, and then also adding in ambient capabilities to some of that frozen and chilled infrastructure to really enable us to be able to deliver that kind of organic growth model of delivering more ambient products to those 19,000 frozen and chilled customers nationwide.
Thanks. I think the other questions we've answered during the presentation, so if that's okay, conscious of time for everyone as well, we'll pass back if that's okay.
Absolutely. Paul, David, Ben, thank you very much indeed for being so generous of your time then addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so, and we'll publish all those responses on the Investor Meet Company platform. Paul, just before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, of course, Carol. First of all, thanks everybody for attending the meeting. I think what we try to do today, and we've done it in the best fashion we can, is to give you some flavour of KITWAVE beyond the figures and behind the figures, because that's the public image, isn't it? It's the profit and loss. And we try to tell you about our business, and what I hope we've got across is that whilst we're a business involved in M&A and we're growing at a reasonable pace, what we're not is we're not a risk-taking business. What you'll see with KITWAVE as investors over years to come, you'll see a step approach to our sort of growth. So by that I mean we'll make an acquisition, then we'll stop, we'll look at the acquisition, we'll integrate it correctly, we'll make sure that we maintain the customer base, we maintain the employee base before we move on again. So you'll not see us running at 100 miles an hour. What you'll see is just every year we'll get a little bit larger, and just continue that steady, safe progression, because that's what KITWAVE is. We're a business that is dependable. We'll say to you, this is what we'll achieve in the year, and that's what we'll achieve. We're not a peaks in a trough. We're just step by step, steady growth, year on year after year. You'll just see us slowly tick from that original point of £2 million per annum to £2 million per day, £500 million this year. Give us another 5 years, you'll start to see a business doing £1 billion, but equally with the same profitable base.
Paul, that's great. And Ben and David as well, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KITWAVE Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.